Let's get some more on what the market's thinking about this morning. David Nelson is chief strategist at Belpointe Asset Management. David, coming into this data today, we had seen a market that was pretty much rocking and rolling. We had well-received corporate earnings. The NASDAQ yesterday was at an all-time high. What is your general takeaway on the latest set of economic numbers and what it means for the markets?
You tell me where rates are going, and I'll tell you where the market is going. Okay. The market is very fixated. The market's very fixated on the risk-free rate for good reason. It's where most valuation models start, and we understand that each stair-step higher in rates likely means institutional capital comes out of the market. So as long as rates can remain benign, we can probably, do okay with rates higher for longer. What we can't deal with is rising rates, because when they're rising, we have no idea where it's going to stop.
And so, how have you been positioning throughout all of this? What's been the simplest thing for you to do as an investor during this period?
Well, I'm quantitatively based, so I have to watch the factors, what's working, what isn't, and what's next. So I've been constantly monitoring that. And interestingly, over the last month, we've been slowly shifting, a little bit more towards value, a little bit more towards dividends. And it's bringing up some unusual suspects, so to speak.
Yeah, I guess this is an interesting time to talk about a rotation of sorts, because the Canadian stock market is not too far from a record high. We saw one on Friday of last week. Some of that is tied to the idea of cyclical stocks outperforming, that if inflation is sticky, that maybe some of the collection of stocks that make up the Canadian market are a hedge against that inflation. But when you're talking about value and dividends, what are the kinds of sectors that you're talking about?
It's across the board. You can find value almost anywhere you look. I look at Nvidia. Nvidia is actually a value stock, compared to its growth rate. So I'm very sensitive to that. What isn't working is unprofitable growth. With high rates, you can't be in that space. You're going to have to. Investors want some food on their plate, and I'm finding it in almost every sector at this point.
Yeah, we're about a week away from Nvidia's quarterly results, and yes, the stock is up more than 200% over the last year, but just even looking at the income growth that is expected in the next couple of years, looks like it's going to be, at least on EBITDA, 60–70%. So an explosion in profitability for this company. At what point does that become a story that just has run its course for those investors who believe that when you have these big run-ups, even if the business is poised for growth over the next few years, that it's good to take some money off the table from your biggest portfolio winners?
Well, I've already done that. I mean, I've trimmed Nvidia 3 times, and I'm actually a little uncomfortable going into the quarter because I'm a bit underweight what it is versus the S&P 500. I think the real opportunity for many investors who maybe have missed the ride is AI is touching almost every single industry out there. It's going to be, it's obviously a theme that's going to be with us for quite some time. I've actually looked to the utility sector very quietly on Monday. For briefly, it became the best performing sector year to date. And typically that's a defensive move. It's where you go to high. But I think there's actually something else going on right now. The one thing we're looking at is that we know that AI demands power, and we're lacking it. And we're going to need power and lots of it. And by definition, the utility sector is going to grow. Revenues are going to go up. And those with good business models will see their bottom line grow. Goldman was out with a research report just yesterday saying that they expect the demand for electricity to accelerate 2.5% annually for the next decade. So I'm looking at a 2.5% sector in the S&P 500 on its way to 5.
Yeah, I'm glad you brought that up, because we've had a number of pundits talking about it for really a year now, that if you have these massive energy needs, who's going to be providing them? There is an ETF that you've been tracking. The symbol on that one in New York is UTES, and that would be representative of some of the utilities that you're talking about. I'm looking within the makeup of that exchange-traded fund: NextEra, Constellation Energy, Vistra. These seem to be the kinds of companies that come up when people have this conversation around power needs.
Vistra is actually up more than Nvidia in the last year, if you can believe that.
Wow.
That's how staggering this sector has actually become. Constellation Energy is a nuclear play. I chose Unicorn Tango Echo Sierra. I chose that ETF. To the best of my knowledge, it's the only actively managed utility ETF out there. There are a lot of open-ended funds out there that do it, and we're actually in a world where I almost think we're at peak passive. I think you're going to see investors move to actively managed product because they're frankly doing a better job right now.
Okay, and then a final pick you brought today is a company, I believe it's called Leidos. It's a well-liked stock on Wall Street. I think they recently had a deal with Amazon Web Services. What's this business all about?
It's defense. They're very entrenched in the defense industry. They touch almost every branch of the service. Not typically large hardware items. There are a lot of mission-critical software. I use it as a pilot. If I'm calling up for a weather briefing or filing a flight plan, I'm talking to a Leidos engineer. So the stock's pretty extended here. So I would say buy half right here and then wait for some kind of pullback to get in. But this trades under a market multiple, and this is a very, very steady grower for quite some time.